Welcome back. Let's focus on Indian Metals and Ferro Alloys. The company has reported a muted top-line growth of just about 3%, but the company's margins have expanded. So margins have improved from 10.7 to 21.7%. And this is largely aided by a very sharp reduction in the company's overall expenses. So therefore, despite a just 3% increase in the company's revenues, the profit jump is quite significant, and add to that a higher other income. Subhrakant Panda, the managing director at Indian Metals and Ferro Alloys, is here with us on the show now. Sir, first, if you could tell us this other expenses, which has fallen quite significantly on a year-on-year basis, boosting your margins, is what led to that? Was there something in the base year? Is there a one-off? And how do we look at that number going ahead?
Good afternoon, and always good to be on the show. So, in as much as our numbers are concerned, as you know, in a commodity space, we are dictated very much by where the commodity cycle stands. And if I look at our performance in Q2 of FY24, what we have definitely benefited from is a sharp fall in operating costs. Actually, to be honest, I haven't kept track of the other expenses, but operating costs are down sharply. And that's a result of things like inputs like thermal coal, which we use for power generation, as well as metallurgical coke, which we use for our smelting process, all being down significantly. And that is what has led to the expanded margins, even in a scenario where actually ferrochrome prices have fallen from about 115,000 rupees per ton in the corresponding quarter last year to roughly about 109,000 rupees per ton in Q2. But that has been more than compensated by the reduction in operating expenses in terms of inputs. And as you know, we of course are have the benefit of captive chrome ore mines, and that is always something which is a significant strength. And on top of that, we of course have a fully integrated the fully integrated operations and a debt-free balance sheet, all of which, in a scenario where interest rates are rising, all of these factors sort of have come together to lead to what I would say is a solid set of numbers under the circumstances.
Okay, so Mr. Panda, can you give us a sense of whether these expenditure or these expenses are lower so far in Q3 as well? Have you seen any uptick in these costs? And secondly, what did realizations look like in Q2? And how are they trending in Q3, if you can give us a broad range?
Sure. So first, on the realizations question, if you look at where we stand in Q3 versus Q2, so prices have gone down a bit more. All of this is reflective of the fact that China is going through a period of stress. There is degrowth in stainless steel production of about 1.7% or so globally. So all of that is leading to a gradual decline in realizations for ferrochrome as well. So from Q2 to Q3, prices have come down from 109,000, as I said, to close to about 103,000. But in terms of costing, while thermal coal remains roughly the same as what they were in Q2, but metallurgical coke is going to go down further. So the fall in realization is more than compensated by the fall in input costs. And from that point of view, going ahead for not just Q3, but the second half of the ongoing fiscal, we do expect our EBITDA margins to be 20% or better. And that should therefore lead to quite a strong performance during the year.
Okay, so just to get the number right, realizations in Q3 are back down to 1.03 lakh tons, right?
That's the 1.03 lakh rupees a ton,
okay.
Yes.
So, So Q2 is 1.09. Again, in Q3, you're seeing pressure. It comes down to 1.03. But EBITDA margin should hold above 20%. Can you give us... can you talk about what the export mix was in Q2 and how will that change in Q3?
So broadly, for quite a while now, we have been 90% plus in terms of exports. And that's a result of several things. The fact that historically, ferrochrome from India has been exported. About half of the output is always sort of exported. In our case, given that we have long-term contracts overseas and we prefer operating on quarterly contracts and the like, we have maintained a mix of about 90% exports. But just to remind you that we are expanding our ferrochrome capacity by about 40%. 100,000 tons per annum plant, 2 furnaces actually coming up in Kalinganagar of Jajpur district in Odisha. And we expect that to be operational in the middle of 2025. So that's roughly about FY26. And that will sort of start reorienting us more towards domestic consumption, because the plant is coming up in what is the hub of stainless steel production in India, which is Kalinganagar. And clearly what we are looking is, as stainless steel production picks up more and more in India, because we are now getting to be that size of an economy, and the mix of the economy in terms of there being a preference for stainless steel. Keep in mind again that if you look at initial acquisition cost, carbon steel is a better option. But if you look at life cycle costing, which is what mature economies start to look at, then stainless steel is definitely a preferred choice. And therefore, going ahead, stainless steel production and consumption in India will increase. And we expect our output to, our sales to orient more and more towards domestic consumption.
Okay. Mr. Panda, would have loved to chat a little bit more, but completely out of time. But thank you so much for joining us today and giving us all those details. So that's the word coming in from the company. We'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side. Stay tuned for that.